Hello students, this is Dr. Mercado. Once again, welcome back to Accounting 2302, Managerial Accounting. Now in today's lecture, we are going to be covering content from Chapter 22, which deals with budgeting. I think this is one of the most complex chapters. It has just a lot of information, and preparing budgets is a critical task. So please make sure that you do read the entire chapter before you begin attempting any of your assignments. Now, for purposes of this lecture, the problem that I am going to be covering entails preparing a cash budget. Okay, that would be problem 2204, and you will be seeing that on your final exam. That is why I'm covering with you. That way you can make sure that you understand how to do it. Okay, so the problem is quite lengthy. You are provided with a lot of information that can be overwhelming. So it's very important that when you are tackling problems like this, that you read it carefully 2 or 3 times before you begin actually doing your calculations. So we are going to be preparing a cash budget. Okay, so the problem reads, the controller of Bridgeport Housewares instructs you to prepare a monthly cash budget for the next 3 months. You are presented with the following budget information. We've got sales of $250,000 for September, $300,000 for October, and $315,000 for November. We've got manufacturing cost of $150,000 for September, $180,000 for October, and $185,000 for November. We've got selling and admin expenses of $42,000 for September, $48,000 for October, and $51,000 for November. And we're going to have a capital expenditure of $200,000 in November. Now this is where it gets tricky. Okay, the company expects to sell about 10% of its merchandise for cash. So out of the sales that you are having, 10% of those are going to be paid to you in cash. The rest are going to be on account. Of the sales on account, 70% are expected to be collected in the month following the sale, and the remaining the following month, which is the second month following the sale. So if you make a sale of an account on September, you're going to get 70% of it in October and then 30% in November. That is very important for us to remember and to understand. Depreciation, insurance, and property tax expense represent $50,000 of the estimated monthly manufacturing cost. So within that manufacturing cost, $50,000 is for depreciation, insurance, and property tax expense. Okay. The annual insurance premium is paid in January. And the annual property taxes are paid in December. Of the remainder of the manufacturing cost, 80% are expected to be paid in the month in which they are incurred, and the balance in the following month. Okay, so that's also very important because we're going to be breaking down our manufacturing costs. 80% we're going to pay them in the current month, and then 20% the following month. Okay. So, current assets as of September 1st include cash of $40,000, marketable securities of $75,000, and accounts receivable of $300,000, $60,000 from July sales, and $240,000 from August sales. Sales on account for July and August were $200,000 and $240,000 respectively. Current liabilities as of September 1st include $40,000 of accounts payable incurred in August for manufacturing cost. All selling and admin expenses are paid in cash in the period they are incurred. An estimated income tax payment of $55,000 will be made in October. So we need to consider that when we do our calculations for the month of October. Bridgeport's regular quarterly dividend of $25,000 is expected to be declared in October and paid in November. So that's going to be something that's going to be impacting our November numbers. Management desires to maintain a cash balance of $50,000 per month. So we're going to see if that's something that's going to happen or not based on the data being provided. Now, for the summary, I brought over just a small section that entails talking about the cash budget, but there is just a wealth of information provided to you in the ebook. Okay, so what is a cash budget? The cash budget presents the expected receipts and payments for cash for a period of time. Cash is super important for any business because it is used for the operations to make decisions. Are we going to buy? Are we going to sell? What are we going to do? Okay. So the cash budget estimates the expected receipts. Receipt is inflows. This is money coming into the business. And payments, which are outflows. Those are money leaving the business of cash for a period of time. The cash budget is integrated with the various operating budgets. In addition, the capital expenditures budget, the dividends, and equity or long-term debt financing plans of the company also affect the cash budget because they impact cash. Okay. Like the other budgets illustrated in the chapter, a cash budget can be prepared annually. However, because of the importance of maintaining sufficient cash to run operations, cash budgets are normally prepared quarterly, monthly, weekly, or even daily. Okay? Where I used to work, we would prepare the cash budget on a daily basis. Okay, we needed to make sure, if we were aligned with our budget expectations. If not, we could make adjustments. Okay. So this is just a small section. I am going to show you that the cash budget section has a lot of information, a lot of examples that you need to follow. They have schedules showing you calculations for specific areas of the cash budget that you need to prepare. And I'm not going to, go through all of this with you, but there are information being provided that outlines how to complete the different calculations. You just have to invest a little bit of time and effort into trying to figure out what is it that we're doing, okay, in this different sections, okay? So there's a lot of information on the cash budget. They've got a completed cash budget for you. So there's two different schedules being provided that we have to prepare that will allow us to input some of the data in the cash budget. So please read over all of this section in your ebook. It's section 22-5A, which deals with the cash budget. Okay, so now I am going to start working on the actual budget. Okay, I've already set it up for you. We've got Bridgeport Housewares. This is the cash budget for the 3 months ending in November the 30th. So we're going to be doing September, October, and November. Okay, so we're going to begin with the money coming into the business. Okay. So we're going to start with our estimated cash receipts. Okay. And we have different sources of money coming in. Okay. We've got our cash sales, and we've got our collections of accounts receivable. So for this particular business, most of our cash receipt is from the accounts receivable. Okay, remember, the first line item says the company expects to sell about 10% of its merchandise for cash. So that means that 90% of the sales you're making are on account, which means we're going to get paid later. Of those 90% of the sales, okay, 70% of those sales are going to be collected the month following the sale, and the remaining 30% is going to be collected the following month, so the second month following the sale. So those are things to consider. So let's tackle the cash sales first. That is fairly straightforward. It says the company expects to sell about 10% of its merchandise for cash. Okay, so what are we going to do? Well, we're going to look at our sales for each of the months. Okay, let me pull it over. Where did it go? Over here. Okay, so let's look for September. In September, we have sales of $250,000, and 10% of those sales are going to be in the form of cash. So that means that we are going to receive $25,000 for September in cash sales. Okay. For October, we have sales of $300,000. We're going to multiply that by 10%, and that's going to give me $30,000 for October cash sales. And then we are going to get November. November, we've got $315,000 times 10%, and that's going to give me $31,500. Okay. So that is fairly straightforward. On the first sentence, it tells you the percentage of sales for cash, 10% right there. Okay. So it's super important that you locate the information and that you apply it to the problem. Okay, 10% of its merchandise for cash. Okay, now we're going to go to the collections of accounts receivable. Now for this, we are going to have to create a schedule because it gets complicated. Okay, so I've already set it up on the side for my schedule for collections of accounts receivable. Okay, so we've got July, August, and September. Okay, and why am I going back to July? Well, let's look down here at the bottom, okay? And let's read over this section right here. Okay. So it says, current assets as of September 1st include cash of $40,000, marketable securities of $75,000, and accounts receivable of $300,000. That's pretty big. Okay, so we've got $300,000 of accounts receivable. That is money that is owed to us for sales that have been made in the past. Now, $60,000 from July sales and $240,000 from August sales. So remember, 70% of the monies that are made on account are collected the month after the sale is made, and then 30% the second month after the sale is made. So now this is going to help us. We've got $60,000 from the July sales. So if we made sales in July, then that means in August we will receive 70%, and then in September we would be receiving 30%. Okay, so we need to remember that. Okay, so from the July sales, I'm going to put that over here. From the July sales, I've got $60,000 that we are pending to collect, and I'm going to do my calculation here on the bottom. Okay, so the July sales, okay, it says here that we have money coming in from the July sales. So that money was, we made the sale in July. In August, we collected 70%. And in September, we're collecting the rest, which is $60,000. So that $60,000 is coming from that sale that we made in July, okay? So let's bring that over. Let's see, what else do we have? Okay, sales of account for July and August were $200,000 and $240,000 respectively. Okay, so that information is also very important. Okay. Okay. So, how many sales did we have in July? Okay, in July we had $200,000 of sales. And in August, we have $240,000 of sales. So we have to allocate, okay? So the problem says 70% the month after the sale is made, 30% the second month after the sale is made. So let's tackle first July, okay? In July, we had sales of $200,000, okay? So in July, we had sales of $200,000. So let's do our calculation here. So we had sales of $200,000, and we want to know how much of those sales is going to be collected in September. So we said the first month after the sale we collect 70%. So that would have been in August. August would have collected 70, and now in September we would have collected the rest. So the rest of the collection is 30%. So we're going to be collecting 30% of those sales in September. So let's calculate the 200,000. That was the total sales back in July. And then because this is the second month after the sale, we're going to collect 30% of it. And that's going to give me $60,000. So in September, I'm collecting $60,000 from the sales in July. That's what's going to happen. Okay. Now let's continue with September. Okay. So what also happened, if we go back here, in August, there was sales of $240,000. $240,000 of sales in August, okay? So, we have $240,000 sales in August, and the problem says that the month after the sale is made, you are going to collect 70%. That's what the problem says. So, it's 70% the first month after the sale is made, 30% the second month after the sale is made. So in August, we made sales of $240,000. That means that in September, we're going to collect 70% of that. Okay? So we're going to collect $240,000 times 70%. That will give me $168,000. Okay. So now we're going to move on. Okay. Now, for those $240,000 of the sales in August, okay, let's continue with that data. We've got $240,000. Okay. 70% was going to be collected in September, okay? And then the rest 30% is going to be collected in October, okay? So remember, 70% is collected the month after the sale, and then 30% is collected the second month after the sale. So we are going to get our calculators. So we've got sales of $240,000 in August times 30%. That's going to give me $72,000 that is going to be collected in October, okay? For my August sales, 72,000. So what did we do here? Well, those August sales that we had August sales of 240,000. Okay, we had August sales of 240,000. In August, we're only going to collect the cash sales, so that was going straight out. Okay, everything else that was sold on account, we have to collect it in 2 periods. The month after the sale, we collect 70%. The second month after the sale, we collect 30%. So in September, we're going to be collecting 168, and in October, we're going to be collecting 72,000. Okay. So now we are done with July and August. Okay. So now let's figure out the data that we currently have. Okay. So let's look at September. Okay. In September, we've got sales of $250,000. Are we going to collect anything in September? No. The only thing we collect is that cash that we receive. But anything sold on account, we're not going to collect till October and November. Okay? So let's do the calculation for the 250. Okay? So how much do we have in sales? We have $250,000. Okay? Pay attention here. I'm going to multiply that by 90%. Why 90%? Because that is what's going to be paid on account. Remember, it's 90% on account, 10% on cash. Okay? So what are we worried right now on dealing with? Accounts receivable, what was sold on account. So 90% of those sales were sold on account. And then the following month, we're going to collect 70% of that money. Okay? In September, we don't collect anything. We're going to collect till October and November. Okay? So let's get our calculators. 250,000 times 90% gives you that, times 70% gives you 157,500. When am I going to collect those 157,500? Well, if I made the sale in September, that means I'm going to collect that 157,500 in October, the month after. Okay. And then I'm going to do the same thing. 250,000 times 90%. And remember, we multiply 70% the first year after the sale is made, 30% the second month after. So if we made the sale in September, we're going to collect 70% in October and 30% in November. So let's calculate how much we're going to calculate in November or collect in November. Got 250,000 times 90% times 30%. That'll give me 67,500. That 67,500 from my September sales is going to be collected in November. Okay? Of 67,500. Okay? Okay? What else am I going to collect in November? Okay? So we're going to go back to the data. So we've already tackled September. September is going to be collected in October and November. So now we're going to go ahead and we're going to do October. In October, we have sales of 300,000. That means we're going to collect 70% in November and we're going to collect 30% in December. For purposes of this problem, I don't care about December. I only care about what's going to happen September, October, and November. So just remember, what we sell in October, 70% will be collected in November and then 30% in December. So let's tackle that calculation. For our October sales, we have October sales of 300,000. and we are going to be collecting 90% of that because 10% is cash. And the month after the sale, we're going to collect 70%. Okay? So that means if we have the sale in October, we're going to be collecting 70% in November. So that's 300,000 times 90% times 70% of the collection. That'll give me $189,000. When am I going to collect those 189,000 from October? In November. We're going to collect that in November. This goes up here. Sorry about that. And then this goes down here. 189,000. I put it in the wrong cell. Okay. So now that I've got my collections for September, October, and November, okay, I can get my totals. Okay. Now I don't have to worry about the other sales on account because those are going to be collected in December. My sales from November are going to be collected December and January. So I'm not interested in those data. I'm only interested up to my collections for the month of November. Okay. So now that I've got that, I've calculated my totals. That is what we're going to flow into our actual cash budget. Okay. So collections of accounts receivable for September, we're going to collect $228,000. For October, $229,500, and for November, $256,500. Okay, these numbers are coming from our calculations on the side, and all of the calculations having been included for your reference. Okay, so now that we've got that, we can go ahead and resume our cash budget, and we're gonna have our total cash receipts. How much are we gonna receive in total? So we're going to add those numbers, okay, together. So you just add your cash sales plus your collections of accounts receivable to get your total, okay? And there we have it. 253,000, 259,500, and 288. Okay, that is what we are expected. The money we are expecting that is going to be coming into our business. The cash that's going to be coming into our business. Now, we're going to deduct estimated cash payments. Cash payments are an outflow of cash. This is money leaving the business, okay? So, the first thing we're going to calculate is manufacturing costs. Okay? And I misspelled manufacturing. There we go. So for manufacturing costs, we are going to create a separate schedule. Remember, we have two schedules, one for the collections of accounts receivable and one for the payments for manufacturing costs, okay? So let us work on the calculations for that, okay? So let's go back and worry about manufacturing costs, okay? So let's see what it says. Depreciation, insurance, and property tax expense represent 50,000 of the estimated monthly manufacturing costs. So we know that these three items impact manufacturing. So these are not really manufacturing costs. These are basically just the overhead, the depreciation, insurance, and property tax expense, okay? So remember, in manufacturing costs, we've got our materials, our labor, and our overhead. So the depreciation, insurance, and property tax represents 50,000 of overhead, basically, okay? The annual insurance premium is paid in January. Okay, of the remainder of the manufacturing cost, this is important. Okay, this is where we're going to be getting the data. Right here. So it says, of the remainder of the manufacturing costs, 80% are expected to be paid in the month in which they are incurred and the balance in the following month. So we're going to have to calculate our manufacturing costs less our overhead, and then whatever balance we have left over, that's going to account for our actual manufacturing cost. We're going to go ahead and 80% of that is going to be allocated that current month, and then 20% the month after. Okay, so we have to break it out into two. So let's do some calculations. So let's do the first calculation first. So let's look at September. Okay. September, we've got manufacturing costs of $150,000. So we're going to look at manufacturing costs for September, $150,000. Okay. And I am going to subtract. Okay, let me put this because we're going to do a little bit. We're going to get the $150,000, and I'm going to subtract the $50,000, which is your overhead. Okay. Let me see. Do they give us, let me see. Let me continue reading because we should have data for the prior month. Okay, right here. Okay. Current liabilities as of September 1st include $40,000 of accounts payable incurred in August for manufacturing costs. All selling and admin expenses paid in cash in the period they are incurred. Okay. So we have here current liabilities as of September 1st include $40,000. Okay. So that $40,000 is given to you. Okay. The payment of accounts payable beginning balance of the month. So that means that those $40,000 are being carried forward from August. Okay. Current liabilities as of September 1st include $40,000 of accounts payable incurred in August for manufacturing costs. Okay. So that is coming from the data. Those $40,000, there is no calculation for that. So that is going to be something that's going to have to be paid, and that's our starting point, $40,000. And these $40,000 are coming from your beginning accounts payable balance, which is given to you in the problem before we actually start the calculations right here. Okay. So that's our starting point. We have to pay what we owe from last month that we stayed pending. Those $40,000 will be paid in September. Now, the payment of the current month. Okay, so payment of the current month will be the $150,000 from September. And remember, we are paying 80% in the month in which they are incurred, and then the balance, 20%, the following month. So here we have manufacturing cost of $150,000 minus the $50,000 of overhead. And then I am going to multiply that by the 80%. This month we are going to be paying 80%. Well, you know what? Let me restart. Let me run my numbers across instead of going down. I think it will make it easier if we just do September, October, and November. Okay. So let's do. We did the $40,000 that's coming from the problem. Now let's work on October. My beginning payment of AP balance beginning on the month. So that way we can run the numbers across. I think that will make more sense. So I'm going to put here the $40,000 given in the problem. There's no calculation. Okay. And then number 2, and this is for, let me categorize it that way we can know what we're doing. A little bit more organized. Okay, for September, the $40,000 is given in the problem. Okay, now number 2, this is for October. Okay, so for October, we are looking at, okay, what is going to be paid in October? Okay, so in September, we've got manufacturing cost. In October, we're gonna have the what is going to be the balance due? Well, in October, the balance due will be the 20% from September. Okay, so in October, the payment that needs to be made is the $150,000 minus the $50,000 overhead. Okay, and then we're gonna multiply it by 20%. Okay, and why 20%? Because remember, in September we pay 80%. In October, we pay 20%, the remaining 20%. So we're calculating it from the September figure. And then that would give us $150,000 minus the $50,000 times the 20%. So that will give us $20,000. So in October, I am going to pay $20,000 from September. Okay, $20,000 from September. Okay. Now, in November, okay, I am going to pay 20% from October. Okay, so I hope that makes sense. So we're paying always the following month 20% of the prior month, always. Okay, So in November, okay, I am going to pay, in October we had sales of, if you look at the problem, in October we have manufacturing cost of 180,000. So we have a manufacturing cost of 180,000. We've got 50,000 of overhead that is fixed, okay? And then we are going to collect 20% of that in the following month. Okay? So that would give us 180,000 minus 50,000, 130,000 times 20%. So that will give me $26,000. Okay? So this $26,000 is for the payment of your manufacturing cost from October. Okay? Because in October we pay 80% and in November we pay 20%. So that will be $26,000. So just remember, we are responsible to pay manufacturing costs of 20% the month after our manufacturing cost is incurred. After, okay? We pay 20% the month after, and then we pay 80% the current month, that which is what we're going to calculate next. So now we started off calculating what we're going to pay the future month. Now we're going to calculate, well, how much are we going to pay this month? So for the future month, it's 20%. 20%. For the current month, it's 80% based on the problem data. It's not always going to be like that, but in this problem, that is the distribution. 20% the next month and 80% the current month. Okay? So let's do our next calculation. So our next calculation is going to be for September. Okay. So in September, we had manufacturing cost of 150,000. Excuse me. Okay, so we have 150,000. I'm sorry about that. And remember, we have to deduct that overhead of 50,000. And we are going to pay 80% the current month. Okay, 80% the current month. So it'll be 150,000 minus 50,000. That's 100,000 times 80%. That would give me $80,000 in the current month. So in September, I am going to pay $80,000 the current month. Okay, we're going to repeat the same process for October. In October, my manufacturing costs were 180,000. I'm going to subtract the $50,000 of overhead, and I'm going to multiply it by my 80%. And let's see what that gives us. So 180,000 minus my 50,000 overhead times my 80% that I'm going to pay this month. That'll give me $104,000. Okay. So that would be 104,000 right here. Okay. And then last but not least, we're going to do the same thing for November. Okay. In November, if you refer to the problem, we had manufacturing costs of $185,000. I'm going to subtract the $50,000 overhead, and then I'm going to multiply it by my 80%. And then that would give me how much? 185 minus 50,000 times 80%, $108,000. Okay, so we've got calculated the 20% is going to be paid the following month after the manufacturing costs have been incurred, and then the current month, 80% of what we're going to pay this month. Now we're going to get a total. We're going to add those two numbers together. And that is what we have. Okay. So in September, we're going to pay $120,000, in October $124,000, and in November $134,000. Okay. So all of the calculations are outlined here. Remember, it's important to read the problem because it explains to you right here, manufacturing cost, 80% are expected to be paid in the month in which they are incurred, and the balance, which is the additional 20%, the following month. Okay, so it's explained in the actual context. Okay, so now that we have that, we can bring in that data into our budget report. Okay, and now these are cash payments. Because they're cash payments, they're an outflow of cash. I'm going to put them as minus. Okay, or I'm going to put them in parentheses. So for let me scoot that up. For September, we have 120,000. And these are outflows. Okay. Okay. So we've got 120,000 for September, then 124,000 for October. And then we have 134,000 for November. So I'm bringing these over from here. Okay. So we've got the manufacturing cost. Then we're going to go ahead and we're going to bring in, what else are we paying? Well, we're paying for selling and admin expenses. Okay. The selling and admin expenses are given to you. There's no adjustment being made to selling and admin, so we're just going to bring those numbers over. So we spent $42,000 in September. We spent $48,000 in October, and we spent $51,000 in November. Okay. And these are outflows. Remember, that's why they're negatives. This is money leaving the business. Okay. What else do we have? Well, the problem says we have a capital expenditure. Okay. If you read at this bottom section, okay, it says here that, let's locate the information. Where did it's right here. Capital expenditures, $200,000. You see, it's gonna bite you. It's right there in front of you. Capital expenditures happen in November. Okay, $200,000. So we have to put it in the November section. 200,000. Okay. So we have it right there. Capital expenditures is coming in, and then we have other items. So we have a payment of income tax. Okay. If you read towards the bottom, it says here, an estimated income tax payment of $55,000 will be made in October. Okay. So we need to get that data and put it in the table. Income tax will be made in October. Okay. So it's a lot of reading. Okay. Making sure that you take care of all of the items being referenced in the problem. So we've got $55,000 in October for income tax purposes. So we have that $55,000 over here. Okay. Okay. And then what else do we have? We have dividends. We're going to pay out some dividends. And the problem says down here, Bridgeport regular quarterly dividend of $25,000 is expected to be declared in October and paid in November. So it's important for us to identify where are we going to put it, when we declare it or when we pay it. And you have to think, okay, well, when is the money leaving the company? When I declare that I'm going to pay the dividends, or when I actually pay them out? Okay, and we're going to record this transaction when it affects cash. And when does it affect cash? When I make my dividend payment. So I made my dividend payment in November of $25,000. So I'm going to have dividends of $25,000 in November. Okay. And I believe that is all that we have. Okay. So now we're going to calculate our total cash payments. How much did we spend, or how much are we anticipating spending each month in the different categories? So we're going to add up our totals here. We're just going down and we're adding up our numbers. Okay. And that gives me $162,000 for September, $227,000 for October, and $410,000 for November. Okay. Okay. So that is what we have currently. Let me see. Why doesn't it work when I do top and bottom? You see, it doesn't want to do it. Let me do this. Okay. So here we have the 162, the 227, and the, let me change this just to the bottom border. Okay. The 162, the 227, and the 410. Okay. That is the money, the total cash payments. That is what we spend on every month. Okay. The 162, the 227, and the 410. Okay. That is our estimated cash payments for each of the months. Now we have to figure out if our cash is going to increase or decrease based on our estimated cash receipts and our estimated cash payments. Okay. So we have cash increase or decrease. What are we going to have? Okay. So to do that, we're going to get our total cash receipts less our cash payments. Okay. So it's going to be the $253,000 minus the $162,000. That gives you $91,000. Okay. So you're going to do the $259,500. That is what you're expected to receive in cash. And you're expected to spend $227,000. That leaves you with $32,500 for October. Now November is a bad month. We are expected to receive $288,000 in cash, and we are anticipating paying $410,000 in cash. That's going to leave me in my red $122,000. Now we're going to add our beginning cash balance. Now the beginning cash balance is provided to you in the problem. Okay. If we look at the first sentence here, current assets as of September 1st include cash of $40,000. And we're only interested in cash because we are doing the cash budget. So my beginning balance is $40,000. Okay, $40,000 was my beginning cash balance in the month of September. Okay, now I can calculate my cash balance at the end of the month. Okay. So if I have $91,000 cash increase plus my beginning balance, then that's going to bring my cash balance at the end of the month to $131,000. Now at the end of the month, that is going to be your ending balance for September. Okay, so you're going to be using this figure because this figure is going to flow into the following month. So that means your ending balance for September is 131, which means that your beginning balance for October is 131. Now that you've got that, you add your cash increase and decrease plus your beginning balance, and that'll give you $163,500. That is how much cash you have at the end of October. Okay, that is your cash increase or decrease for that specific month plus your prior month's ending balance. Now for November, your beginning balance will be the ending balance that you have in October. We're going to carry that $163,500 over. Okay, so your beginning balance for the month was $163,500, and then you have a cash decrease of $122. So you're going to add those two together, and that's going to leave you with a cash balance of $41,500 at the end of November. Okay. Now, the company wanted a minimum cash balance, and the minimum cash balance, according to the problem, is management wants, insert shapes right here, management wants to maintain a minimum cash balance of $50,000. Okay, so $50,000 is my target. I should have $50,000 at all times so I don't spend that money. Okay, that should be my balance every month. Okay, let me just copy and paste it. Okay, and let me format it. So that should be my cash balance, less the minimum cash balance. So, do I have an excess of cash or do I have a deficiency? Remember, we do not want to touch $50,000. That is what we always want to have in our bank. Okay, so if we look at that, okay, let's calculate if we are able to meet that requirement. Okay, all right, cash balance less your required minimum balance, and let's see if we are going to meet to that. Okay, so if we do the calculations, our cash balance minus the minimum cash balance required, the month of September, we're going to have $81,000 available on top of that $50,000 that we are required to have. So we're in good standing in September. In October, we're even better. Okay, we have an ending cash balance of $163,500. We want to keep those $50,000 aside, and we're still going to have an additional $113,500 available, which is more than enough. Now in November, we're not meeting the requirement. Okay, we have a cash balance of $41,500. Our minimum requirement is $50,000, so we're short of that minimum requirement. We're deficient $8,500. Okay, so we are deficient in the month of November. Okay, this is the cash budget. It is not very complex to compute. It's just two main things: your cash receipts and your cash payments. Okay, but you do have to prepare additional schedules to be able to come up with those numbers, and then clearly understand the rules of, how much are we going to collect the month of, the month after, or the second month after. So you need to be reading the content very carefully and understanding what is it that, what's happening in the particular problem or scenario. Okay. So the first requirement is to prepare the cash budget, which we've done. Everything's there. Okay. And no border. Okay. So it is done. Now the second part says, on the basis of the cash budget prepared in part 1, what recommendations should be made to the controller? So you've got the cash budget in front of you. Now you see the numbers. You see what's going to happen in September, October, and November. If everything goes according to plan, what are you going to recommend to the controller? Okay. So we can observe here that the budget indicates that the minimum cash balance will not be maintained in the month of November. And why is this? Well, this is due to the capital expenditures requiring significant outflows during the month. So if we see, we have a $200,000 capital expenditure that we didn't have in the prior 2 months. So that $200,000 capital expenditure is what's throwing us off. Okay. Now this situation can be corrected by either borrowing money or by the sale of marketable securities. Okay, so we do have marketable securities of $75,000 in the problem. If we don't want to run to this problem where we're below the minimum cash balance required, then we can sell those marketable securities, and that will bring in an additional $75,000 or more, and that will allow us to be back in the positives and meet that minimum cash balance criteria. Or like I said, you can borrow money. Okay. At the end of September and October, the cash balance is going to exceed. If you notice, we've got the $50,000, and on top of that, we have quite a bit more money left over. So the cash balance will exceed the required balance, and that can be used for like temporary investment. You don't want to have your money just sitting there, not earning any interest or not accumulating any more wealth. So usually what businesses do is that have that minimum requirement of cash. We're not touching those $50,000. Anything over that is going to be invested, short-term investments, so we can be able to make some money off of it instead of just being sitting there and not earning any money on it. Okay, so those are some possible recommendations that you can make: getting a loan, selling the marketable securities, and of course investing the excess cash that you have in September and October. Okay. So those are just some of my recommendations that I would make. This cash budget problem, you will see something similar on your exam, on your final exam. So please make sure that you understand it, that you carefully review my calculations. Everything is outlined here in the problem. You can watch this video as many times as you want, go back and forth, so you can be able to understand what is it that I'm doing. Okay. Please do not forget to read the chapter. Practice, practice, practice. That is how you are going to learn. And if you come across any questions or having any issues, please make sure that you send me a screenshot of the problem that you're working on, and I want to see your work. That way I can see what you're doing. I want to see your step-by-step calculations. If you see here, I am showing you how I got each of the numbers. Don't just send me your spreadsheet with a number and I don't know how you came up with that number. Okay, I want to see your calculations so I can be able to see what you're doing and provide guidance. Okay, so if you have any questions, do not hesitate to contact me and I will be more than glad to assist you. And that is it for this problem. Until next time, have a wonderful rest of your week. Bye-bye.